Good morning, good afternoon, good evening, depending on where you're listening to this from, and welcome to Dorsey and Whitney's webinar on the Silicon Valley Bank and Signature Bank failures. I'd like to introduce Joe Liniak, a partner in Dorsey's Finance and Restructuring Group. Joe?
Oh, thanks very much, and welcome everyone to today's webinar. I'd like to go over a couple of housekeeping details before we start. We normally limit these presentations to 60 minutes, but we may go over a few minutes today because we've got so much information and issues to be discussing. We hope you can stick with us, but we understand if you need to leave. Reminder to sign in on the attendance form. The materials and attendance form are available for download for the remainder at events@dorsey.com. Please don't forget to return your completed attendance form. Dorsey will apply for CLE in the jurisdictions for the lawyers who want credit. Unfortunately, we've got a lot of ground to cover today, and we probably not have opportunity to do questions, but we have put a whole slew of questions at the end that we've been receiving from clients and friends, so we will try to be dealing with them. If you have a question as a follow-up, please contact us or reach out to your usual Dorsey contact. We will put links to the download for the materials and attendance into the chat, along with the CLE code, the super secret CLE code. And after today's program, we will send out a survey, and we appreciate you giving us some feedback. As a legal notice, just be aware that this isn't intended to be just general information for your purposes, and legal advice is not intended to be legal advice. If you want legal advice, let us know, and we'll be happy to send you an invoice and a bill. In today's speakers, I'd like to introduce my friend, colleague, and really bright bank regulatory partner, Aaron Bryan, who is currently in San Diego and is going to be joining us today. And my name is Joe Liniak, and I likewise am a bank regulatory lawyer. Starting out, what I do want to mention to you, and you can see this, is that one of the truly well-known, nationally recognized icons regarding banking has been concerned about the contagion in the banking system. And as you can see here, he's huddled with his counselors trying to deal with it. So we have been dealing with a crisis, and something which we've all got to be concerned with. On the agenda today, it's going to be hopefully a practical discussion regarding the failures of Silicon Valley Bank, which we may abbreviate occasionally by calling it SVB and Signature Bank, which we may identify by referring it to SB. And we're going to generally follow the following order: how we got here, the current status, and the current status has been changing almost by the minute. For those of us who are not as, thankfully not as old as I am, a primer on FDIC receivership laws, which is probably necessary for a lot of you out there to reacquaint you with what happened, since there just haven't been that many bank failures. A discussion of possible regulatory changes going forward, because on the internet and in the news media, there have been a number of vocal complaints that we need to fix things. And as I mentioned, a Q&A topics, which we will deal with at the end of the program. And with that in mind, I'm going to turn it over to my colleague, Aaron, who's going to walk us through how we got to where we are. Aaron.
Great. Thanks, Joe. And there's nothing more dangerous than trying to fix things before you've fully looked at what was broken in the first place. So hopefully we'll provide some good information for folks to help you as you're forming your opinions about what's happened in recent weeks and what you hope will happen next. We also are really thrilled that there are so many non-bank regulatory lawyers on the call today. We're going to try to strike the right balance between providing enough background for those of you who are probably less familiar with bank regulations, while also giving some important details that will be helpful for people who are fully immersed in this crisis. So I'm going to start out by talking about how we got here. Prior to its stunning collapse last week, SVB had established itself as a premier banking partner for the global tech industry. And for many venture capital firms and startups, it was also their preferred bank. That reign ended when concerns about SVB's health led panicked venture capital leaders and depositors to begin pulling deposits from bank and moving their banking relationships, causing a classic bank run. On March 10th, US regulators stepped in to stop the run on deposits, and in quite a surprise, midday placed SVB under FDIC receivership. That same day, the Bank of England, in consultation with UK regulators, announced the liquidation of Silicon Valley Bank UK. SVB's historic failure also followed the collapse of crypto lender Silvergate Capital early last week. So even by Friday, there was a lot going on here. As of Friday, the date of the bank failure, SVB had $209 billion in total assets and approximately $175.4 billion in deposits. This is really significant and somewhat unusual that over 90% of SVB's deposits were uninsured, meaning they were above the general FDIC insurance limit of $250,000. The FDIC transferred all of the insured deposits into what's called a Deposit Insured National Bank, or DINB, before announcing the chartering of Silicon Valley Bridge Bank, NA. Next slide. Then on Sunday, March 12th, next the FDIC stepped in and closed Signature Bank, which is a New York chartered bank, or was. Signature had assets of $110.36 billion and deposits of $88.59 billion as of the end of 2022. And approximately $10 billion in deposits were withdrawn just last week prior to the closure. The FDIC acted quickly to charter a bridge bank to hold SB's assets and deposits. That bridge bank is known as Signature Bridge Bank, NA. Next slide. So many of you were part of panicked phone calls over the weekend of people figuring out what their personal exposure was and how they were going to deal with this. So in particular, companies that had their payroll funds banked at Silicon Valley Bank and then Signature Bank were very concerned about how they were going to make payroll in the coming weeks if they did not have full access to all of their deposits. Others were extremely worried that their uninsured deposits might just be lost forever, particularly because an assuming bank had not been identified at that point, and there was a lot of uncertainty about whether anyone would be able to step in and what the FDIC would do to protect deposits. Of course, there's no obligation to protect deposits above $250,000, but given the unprecedented nature of this particular collapse, there were people immediately calling for additional steps to be taken. So as of Sunday morning, uninsured depositors at SVB and SB in aggregate were at risk of losses in amounts exceeding $180 billion. One thing that has changed since the last round of significant bank failures in 2008 and 2010 was the establishment of the Temporary Account Guarantee Program to guarantee all insured and uninsured deposits, but that program expired and not without receiving significant criticism before that. In its place, though, Congress had adopted Title II of the Dodd-Frank Act, which limited the banking agencies taking emergency action for uninsured deposits to the most dire situations in which systemic risk was present to the US financial system. So there were folks saying, well, this does seem like a situation where we have systemic risk, the tech industry being so integral to both the US and global economies, really, and a lot of concern about what would happen if they did not step in before Monday morning when people went to access their uninsured deposits and companies had to start making plans to communicate what they were going to do about payroll, for public companies to communicate their liquidity to investors, and those sorts of urgent issues. But Sunday afternoon on March 12th, FSOC members made the necessary systemic risk determination to guarantee all deposits of both SVB and SB. And that was really an extraordinary step, and one that was welcomed by many people who either had deposits at these institutions or were somewhere downstream in the ecosystem, and depending on other companies having access to them for transactions, payroll, et cetera. So how we got here, a few more initial thoughts. Historically, bank failures exceeding $50 billion have been very rare. SVB was the second largest bank collapse in US history. So a lot of people were not actively worried that something like this could happen to an institution of that size. Resolving small bank failures is actually pretty easy and happens not infrequently without much fanfare. But there have been virtually no bank failures since late 2010. And in the time since, the 80s savings and loan crisis and other times that we've had significant bank failures, there's been an entire generation of FDIC personnel that have turned over. So much of that receivership expertise that was developed during previous crises is no longer present in those agencies. And interestingly enough, it looks like neither SVB nor SB were even required to submit a living will. So it's not just the folks at these institutions that, while they may understand the regulations and requirements, don't have as much firsthand experience as they might have in a previous crisis or shortly after. What's also become really apparent is that the general public is no longer at all familiar with how FDIC receiverships work. Many of the companies who were banking at these institutions didn't understand what the risks were or what would happen in the event of a receivership. And the general public has been even more confused about it, which is probably part of why we have such high turnout on this call today, because there just hasn't been recent experience that people can turn to readily understand what's going to happen next and what this all means. Businesses as well do not have that institutional memory anymore regarding the powers of the FDIC receivership's capacity. So Joe and I, like bank lawyers all over the country, have been fielding questions from all types of companies that have some direct or tangential relationship to proceeds at SVB and SB as people navigate all kinds of issues that just have not come up in recent memory. Next slide. A typical FDIC bank closing takes about 90 days, and the preparation happens behind the scenes and out of the public's eye. And then the FDIC will swoop in at the close of business and be and take over and be running the bank by the next morning. So that's how this usually happens. As I mentioned, it was very different in this situation, at least for SVB, where there was panic in the markets. There were there was a run on the bank, and the FDIC had to step into the middle of this in order to prevent more catastrophic consequences. All right, next slide. And of course, these bank failures, as I mentioned, were totally unanticipated. In the coming months, I'm sure we'll see more people pointing out those who were naysayers about the health of the two institutions. I've already seen a couple reports about that. But by and large, the industry did not see these as weak institutions that were vulnerable to failure. So by and large, this was an unanticipated crisis. The closest model that we have for these failures goes back to 2008 with the failure of IndyMac Bank. So I'm going to run through a few things that happened with IndyMac. Now, we've already started to depart from IndyMac's course with SVB and SB, but I think this is still going to be useful for you to think about as you consider the typical course of a receivership and the modern precedent that IndyMac set. So IndyMac was closed on a Thursday and not a Friday afternoon. It occurred after the close of business. Uninsured deposits were immediately frozen by the FDIC. There was a partial advance dividend paid to uninsured depositors, and that also was announced with the SVB closure, that there would be an advance dividend paid, although the FDIC did not indicate what amount that would be. But then in IndyMac, there were no further recoveries. So uninsured deposits received a 50% recovery, and then that was it. With IndyMac, there was a 6-month time delay until an acquiring bank was formed and a purchase and assumption agreement, or what's sometimes called a P&A transaction, was entered into between the FDIC and OneWest Bank, which was the acquiring bank. Critical to the transaction was what's called a loss share agreement. OneWest Bank assumed most assets and liabilities of IndyMac, and in exchange, the FDIC agreed to reimburse OneWest for specified losses, what's termed a loss share provision. And that loss share model became the standard resolution structure ever since. So a little bit more about the current status before I hand it over to Joe to talk about receivership mechanics. Joe is a leading or a thought leader on bank failures and has published extensively on the topic. So I don't want to keep you too long, but I'm just going to note a few things that we know as of today. And again, this is rapidly changing. So by the time the replay of this is available, much of this information will probably be stale. But as of our last preparation for this webinar, this is the current situation. So the FDIC tried to sell SVB and SB on Sunday of this past week, and there were no successful takers. The FDIC tried again on Tuesday, but again, there were no takers. So, one of the issues we have here is that to bring in an acquirer on such a short time frame where due diligence really is impossible is really difficult, particularly with the scrutiny that these banks have been under in recent days. So there's some practical challenges to getting a taker in a situation like that. But in the meantime, SB is now a bridge bank, as is SVB, and they can operate for 2 years as a commercial bank. Next slide. And so what that means is that those bridge banks have stepped into the shoes of the former SVB and SB respectively. And we've received a lot of questions about what specifically this means for particular types of products and transactions. And so we've included some links here that provide an overview of the framework that applies to this. But this is a really important point that in many of these situations, it's going to be contract to contract. And so to the extent that someone is telling you, 100% of the time, this is how this is going to work. That's generally not going to be the case. You really are going to have to look at the particular product and the particular product agreement and what is happening for that category of agreements generally, as well as what's happening with that particular agreement. Next slide. All right, so how is this going to work? As far as we know right now, the bridge banks are going to perform under all failed bank contracts for now, and all counterparties are expected to continue to fulfill their contractual obligations. All vendors who are providing services are expected to continue to provide those services. And then significantly, we've received a lot of questions about this too, but all authorized signers, account details, tax identification numbers, wire and ACH instructions, and other processes in place pre-failure will continue to remain in effect. Vendors and counterparties with contracts with the bridge banks are legally obligated to continue to perform under the contracts, although this is a situation where you want legal counsel on your particular matter because there can be some glosses on that. And the bridge banks are obligated to make timely payments to vendors and counterparties and otherwise perform their obligations under the contract. That's what's supposed to happen. Historically, there can be interruptions. It doesn't always go smoothly, but this is, in an ideal state, what would happen next. And then all obligations of bridge banks are backed by the FDIC and the full faith and credit of the US government. Next slide. So with respect to the obligations of the bridge banks as counterparties, including customers, a few points here. All loan positions, including as lender, issuing bank, administrative agent, and other functions, have now been assumed by the bridge banks. And all commitments to advance under existing credit agreements will be honored in accordance with and pursuant to the contractual terms. Any other duties or roles existing under existing credit agreements will be performed by the bridge banks in accordance with the contractual terms. And all counterparties of the bridge banks may transact with, settle transactions, and otherwise conduct business with the bridge banks. And of course, the bridge banks, it's worth noting, are not themselves in FDIC receivership. So with that, I'm going to turn it over to Joe to give you a primer on bank receiverships.
Oh, thank you. Thank you, Erin. And just going back a moment, Erin was talking about the documents that the FDIC issued. And when you read them, you sit back and say, wow, it's all over. It's not a problem. Puppy dogs and bunny rabbits, and it's all fixed. That sounds good, but the overlay, which is going on in the background, is the exercise of the FDIC's receivership powers. And she mentioned a document, which is the transfer agreement for Silicon Valley Bank, Bridge Bank. You need to take a look at that, because that's going to give you the roadmap of what is going to be happening, again, behind the scenes with the FDIC exercising its powers. And one of the things which is a little bit unusual here is normally the FDIC's receivership powers are in the FDIC Act, going back to actually 1930 or so, and is well understood. We know what they say, but what they did is they utilized Title II of Dodd-Frank Act in order to be able to do what they did, in order to declare a systemic emergency and therefore be able to close them and guarantee everyone's deposits. And in Title II is a recitation which closely mirrors what the FDIC's general receivership powers are. And so we will assume down the line that the FDIC will utilize and interpret those provisions uniformly with what their old, if you will, receivership powers are. But it's a different section. And again, for purposes of trying to track through what are they doing and how are they doing it, they're probably going to have to issue a lot of guidance to us. Also, too, and this is somewhat curious, in the Title II power, and you may have heard this, the FDIC's right of the single point of entry in the case of a systemically important institution, which everyone up until this point thought was either a GSIB or at least a systemically important institution. We found out a systemically important institution goes down to about $100 billion. But what that does allow them to do is to not only take over the failed bank, but also take over through a single point of entry, the holding company as well. And as of this date, they have not taken over the holding company for Silicon Valley Bank. And there are activities taking place in that bank. Query whether or not that will eventually happen, whether or not they want to have that occur. And by the way, Signature Bank did not have a holding company. It was registered with the SEC directly as a bank. But this is something which we've got to definitely keep our eyes on in terms of what they do, because of the interaction between the parties and affiliates becomes really, really quite important. And assuming the fact that both the banks are resolved, the bank receivership process will continue. And as I mentioned, it's going to be continuing behind the scenes. When they finally get somebody to take what may be lovingly referred to right now as a couple of zombie banks, they will be successful in the bidding process. The acquiring bank will assume virtually all the deposits and liabilities through the P&A transaction that Erin mentioned. And right now, the FDIC staff is in at the banks and working to determine what was in the banks, what was the nature of their assets and liabilities, and to what extent they want to exercise their receivership powers over those assets and liabilities, even though initially they may be transferred over to eventually the acquiring bank. Now, something to think about FDIC receiverships. First of all, for those of you that are bankruptcy gurus, you probably know, and you passed the quiz, that banks are not subject to the U.S. Bankruptcy Code. They're subject to the FDIC's receivership powers. And there's really two very important overriding rules. The FDIC as receiver stands in the shoes of the failed bank, including its stockholders, depositors, officers, and directors. It is the bank. And all assets of the failed bank, until they transfer it over to an acquiring bank, are owned by the receivership. And importantly, we'll get into this in a moment, the FDIC, even though they transfer assets over to an acquiring bank, can grab them back and do things to them, as well as affect you as a counterparty to the failed bank. And the FDIC also has a very, very important receivership claims process, which we will talk about in a little bit later, and something which all of you need to make sure you understand. While the FDIC attempts as best it can to minimize losses to the depository insurance fund, which is, one of their goals. What are some of the special receivership powers? Well, the FDIC has got the ability to repudiate or disaffirm contracts deemed burdensome to the receivership, generally within 180 days. And they will go through and say, we no longer want to do business with you. Have a nice day. And by the way, you can file a claim in the receivership, but you don't get lost profits past the day of the closing of the bank. And that's to preserve the deposit insurance fund. And so if you're told that you've been terminated, you're gone. The FDIC also has got the right to enforce a contract, because you may have a provision in your contracts with the bank that states to the effect, in the case of insolvency, bankruptcy, or other assets being deemed appropriate in a receivership, we can terminate. Well, guess what, folks? You can't terminate, and you're not going to be able to terminate until the FDIC tells you can terminate, and they can hold your feet to the fire. And in fact, in the recent pronouncement, which we went over a moment ago, the FDIC said, you cannot terminate now. You must continue to be providing services to the bank in whatever capacity you are as a vendor or a counterparty. And interestingly enough, even though the FDIC has got the ability to affirm those contracts, they get the double dip, meaning that down the line, after they get tired of dealing with you, they can terminate down the line. And so then you have got to file a receivership claim to go get paid. And these things typically involve leases and services contracts with the banks. And so it can go down relatively deep into the local economy in terms of when something has been affirmed, something then can be terminated, and so forth. And also remember what Aaron was talking about. We've now got these replacement banks that are in place, and the FDIC said they're going to be operating for you. But if the assets are transferred back to the FDIC as receiver, the FDIC does not have to honor those commitments. So the FDIC can decide, for whatever reason, there may be a loan involved, there may be a line of credit involved, there may be an operating agreement involved, and we don't have to do anything about it and force you to file a receivership claim. So, for example, outstanding letters of credit, while they are going to be while they've been transferred to the temporary banks that we just talked about a moment ago, if for whatever reason the FDIC decides to take them back, they no longer have to honor them. Other things which you're going to become familiar with and may drive you a little bit crazy is the so-called Dench Doom doctrine, and a Supreme Court case that followed it and incorporated it into the statute, which says that if there's a secret agreement between you and the bank, and it's not reflected on the bank's records, the FDIC doesn't have to honor it. So that if you're having a discussion with your friendly neighborhood banker and the bank fails and the banker said, well, don't worry about it, we're not going to exercise a security interest, you can rely on me, not enforceable. I will say, because I'm kind of a nerd, when you read over the statutory version of the Dench-Doom Doctrine in 12 U.S. Code 1923E, it's impossible to enforce it. It's impossible to comply with it in order to make those contracts enforceable. And the FDIC has always just really ignored the issue. But if you've got a side agreement which is not reflected on the records of the institution, you may have a problem. In terms of the FDIC's powers in regards to courts, courts are prohibited from enjoining actions of the FDIC as receiver when resolving assets. So if they sell something to someone and someone decides to try to go in and get an injunction saying this is not fair, the answer is, guess what? You lose. And in other words, many FDIC actions are not subject to judicial review. These are very, very powerful receivership provisions. And what you're probably going to find is that there's going to be a lot of clarification from the FDIC because some of their own employees are now going to be utilizing them. And behind the scenes, when we finally get an acquiring bank, they're going to be deciding what assets go into the acquiring bank and whether or not they're going to bring some of these assets, either keep them in the receivership or bring them back into the receivership, which may which may result in, for example, offsetting loans you have with your deposits against when staying with the receivership and so forth, even though under the successor bank, it may be operating and you may not have a problem. That is a really quick overview of FDIC receivership law. And now what we're going to do is we're going to segue into a number of questions and comments that we've been receiving from people. And I'm going to turn it over to Erin to start the process. Erin.
Great, thanks. So we've been collecting questions that have been coming in, both business-wise, but also through our personal networks, because a lot of people have questions about just what is going on and what typically happens in this situation and what is happening specifically with SB and SVB. So we're going to run through some of these questions and answer them to the best of our abilities. As we've mentioned several times, this is an evolving situation. And so before relying on any of this to make any particular decision, you really do need to consult your own legal counsel and analyze the issues as they relate to your particular situation. But we do hope that this information will be useful to you as you're trying to wrap your arms around what is going on right now with these entities. So, Joe, let me throw this first question over to you. Questions have come up about the status of SVB Financial and its affiliates. And the types of questions I've been seeing involve ownership and control of assets of the affiliates, the use of dual employees and what happens there, and then also contract rights and what is affected by the receivership, what goes to the bridge bank, what is totally separate from it, whether there are other protections. So those are the types of questions that we've been getting, but let me turn it over to you to give some general thoughts about those topics.
Oh, well, sure, Erin. This goes to the comment we made a while back about the fact that the holding company has not been closed, and also it appears that SPV Financial never filed or may never have been required to file a living will. And the benefit of the living wills is that the government and also individual banks who put them together realized how complex their operations were and who owned assets, who owned contracts, who controlled contracts, who owned systems. And the whole idea eventually was to homogenize the system and to make it much more efficient, making sure that the banks were the ones that were in control. And what we have here is a holding company, which apparently is still in existence, and whether or not they will control operations because they still have got the contractual right to do so with Silicon Valley Bank in receivership and the Bridge Bank and so forth, it may end up for a difficult issue and it may take time to be able to resolve itself. Also, too, These entities probably had dual employees. So that means you can wear different hats and you can have compensation going back and forth. And what the dual employees were doing, and again, who had control of the accounts and where they were located, it becomes complex. Finally, the issue is not going to be too difficult when it comes to the bridge banks and now the bridge bank subsidiaries, because they own the bank subsidiaries and the FDIC controls it, or the bridge bank will control it. And so that's not really the issue. The issue is really up at the holding company, and that's going to have to be sorted out. And I would, looking at my crystal ball, I suspect that a whole lot of additional banks in the future are going to have to file living wills, because this is an instance in which, if they did not at the size level they were at, could definitely be a hindrance. Also, too, again, on a slightly different note, a lot of the living wills were read by FDIC employees over a decade ago. They're now gone, and there may be FDIC employees, as we're thinking right now, that are getting the manuals off the shelf and trying to read them and figure out who's on first and what was the structure. But again, something which will come to pass. Erin, you want to take the next one, which is payroll and employee issues?
Sure. So the initial panic last week for operating businesses that had payroll obligations over the next week or two was, what do we do if all of our funds are at this institution and $150,000 is available, and our payroll obligation that we have to fund next week or the week after is, $1 to $10 million, depending on the size of the company? That was a really significant crisis, and something that that a lot of entities were having to wrestle with. And so Joe and I are not employment lawyers, but thankfully we were working side by side with our employment counterparts at the firm to assist clients in navigating some of these issues. So to the extent it's useful in a similar crisis in the future, companies who are in that situation, who have payroll obligations that exceed $250,000, really are in a difficult position if they don't have access to funds anywhere else. So if all of their bank accounts are at the institution that has failed, if they don't have accounts at other institutions or not sufficient funds at other institutions, what we were seeing is, one option is to reach out to your board, to reach out to other funders to see if short-term liquidity can be provided to make those short-term obligations. Also looking at the particular state laws that apply, because payroll can vary state by state, but whether it's possible to move the payroll date one time in order to buy a little bit more time. And then a very significant issue is how all of this is communicated to employees. So with the size of these particular failures, what we found is that employees were hearing about the bank failures on social media and from the news, and wondering whether their employer was affected by it, wondering whether they were going to get paid, before employers had the opportunity to make those communications to employees. And so that's a really important part of the messaging, is not just making a plan, but figuring out how you're going to communicate it to your employees so that they understand the difference between not having access to funds right now versus truly being insolvent. And that's a company by company scenario. Similarly, our securities lawyers were, busy this past weekend dealing with public company issues. So for public companies that may have had either very small impacts or significant impacts, having to review their individual situations as early as Friday to decide whether disclosures needed to be made, and if so, how to describe what was going on in a way that is accurate and meaningful. That was another challenge that we were seeing, and something that we could anticipate if a bank failure like this were to happen again. And then in terms of regulation and deregulation going forward, I know Joe has a lot of thoughts on this, so I'll turn it over to him in just a second. But one of the fascinating things to me about this particular situation is that, we typically in the US have sort of an anti-regulation wing on the right and a pro-regulation wing on the left. That can vary, of course, by what's being regulated and who's doing the regulation. But generally speaking, there's a difference based on which side of the spectrum you're on. What was interesting about this failure is that it involved tech companies, which I think are perceived a little bit differently in the general public and by politicians than maybe other small businesses or middle market businesses would be. And so the criticisms didn't align quite as neatly as I might have anticipated. There does seem to be some call for changes to the law, changes to regulation coming from both sides to affect the way that this would be handled in the future. And of course, what people are calling for differs, whether that's increasing capital requirements for, $50 to $200 billion banks or, other requirements that would allow the government more insight into what is going on into particular institutions, or whether it's changing the way that these companies can be, for lack of a better word, bailed out, whether that is through the FDIC or through taxpayer money or through other means. So that's been surprising to me and a pretty interesting topic to follow. But Joe, I know you follow this issue really closely, so I'd love to hear your thoughts on this.
Oh, well, thank you. Let me just digress for a moment to the issue about securities disclosures. And Aaron is absolutely right. We helped a lot of companies do 8Ks, but going forward, as you're thinking about your 10Ks, you can probably bet that there's going to have to be a lot more disclosure on the risk mitigation issues and disclosures about your assets and liabilities vis-a-vis what happened in this instance, not only for banks and their concerns and bank holding companies, but also for regular businesses and your relationships with banks and liquidity issues and availability of issues. So this is not going to be a one-stop shopping issue. It's going to be an ongoing thing, which not only with banks and non-banks, as they interrelate with each other and they do their 10Ks, are going to have to look at. And something to turning from a moment to deregulation. Over the last day or so, there's been a food fight in terms of the political side of this. But let me just mention the fact that yes, there was deregulation, but along with deregulation, there was, as part of it, and supposedly this is a cause, there was the ability of the Federal Reserve Board to tailor prudential regulation. And Silicon Valley Bank was in the fourth category of a large bank, and they had obligations. They had obligations in terms of risk mitigation strategies, in terms of liquidity issues, not at the same level as one of the GSIBs, the very, very large banks, but nevertheless, they were there. And I think this is going to be something which is going to be subject to legitimate conversation as to what now constitutes a bank that is too big to fail. Was the degree of regulation sufficient? Was the amount of stress testing, and you can imagine what stress testing is going to look like in the next round in terms of the issue of liquidity and investments in low-grade investments and low-grade securities, low interest rate securities. So these things are now going to be percolating around, and I think there's going to have to be a very, very significant both regulatory and congressional debate on these issues. Let's go on for a moment to foreign branches and ring fencing. And as Aaron mentioned, the Silicon Valley Bank UK was sold to HSBC UK for $1. And they just turned it over, got rid of it. They needed to, but that has to do with the whole concept, which has developed over the last several years globally, of the whole idea of ring fencing. And ring fencing effectively means that you may have a branch in Canada or a branch in Germany, which actually Silicon Valley Bank did. We want to make sure that the assets that are resident for our customers and for our citizens in those countries are backed up by the deposits are backed up by assets in the country. So you've got to balance off assets and liabilities on a country by country basis, and that's what's happened, and there's probably going to be even more of that now because of the necessity of looking at that and ensuring the fact that whether you're a U.S. operation and the U.S. does this to foreign banks as well, you make sure that you have a sufficient number of assets here so that if something happens and the deposits are in jeopardy, you've got assets located nationally to be able to deal with and pay off citizens of your country that have got concerns. Any comments, Aaron, on bank investments for bailout funding?
Yeah, well, I'd love to hear your thoughts on this, but obviously this has been a hot topic in the press about whether the use of bank assessments to handle these bank failures is in fact a bailout or not, and whether this is really taxpayer money. But what's your take on that?
Oh, it is a bailout, absolutely. But in Title II of Dodd-Frank, the bailout funds are going to be paid by an assessment by the big banks. And they are probably going to be not happy to hear about this because who knows what the actual losses are going to be, but that's where it's supposed to come from. And I've heard conversations in the media that, well, this is really a pass-through and a flow-through down through the banks, and eventually the public is going to have to pay. And I'm not an economist, so I'm not going to deal with that. But there is when President Biden indicated the fact that taxpayer money would not be used, he was describing this issue, which is that whatever money is used, because the Treasury will be able to borrow to pay for it, that borrowing will then be paid by the large banks over a period of years. What do you think about identifying alternative financial institutions on the part of customers?
Yeah, this is a really interesting question. So particularly for tech customers, something that was unique about SVB was that it developed itself within Silicon Valley hand in hand with the expansion of the tech industry there. And so they offered products that met the unique needs of their tech industry customers. They had relationships with deep relationships in the tech industry that allowed people to have trust that their relationship banker knew their account and understood their business. They took risks that some other banks might not take because they were able to develop underwriting to look at emerging tech companies and take chances that maybe a financial institution that has less familiarity with the industry might not feel equipped to make. So that's a big void that's being left. And I think for the companies that are looking for new banking partners now, they're going to be looking for banks that understand their businesses and that offer products that work for that particular industry. They're going to be hoping for underwriting processes that take into account the kind of cycles that tech companies can go through as they go from a startup to a mature company. So that's going to be really significant. In terms of who is going to compete for those accounts, we really saw it immediately, even before Silicon Valley Bank failed. There were already neobanks and challenger banks out there saying, come bank with us. We can do what SVB was doing and do it better. But I don't think the challenges are only going to come from neobanks and challenger banks because larger, more traditional financial institutions have invested heavily in building up their technology segment in recent years. And so, the larger institutions are also going to position themselves to take on this business and say, we do have unique products. We do have expertise in these areas. We want your business. We want to work with you. Now, what that means for startups where there is more risk is a little bit less certain. But I have no doubt that across the wide spectrum of the banking sector, there is going to be a lot of competition to try to get these clients to move over. And it's going to be a big shakeup. Silicon Valley Bank was such a huge player in this space for so long. And so now that we don't have that singular entity where VCs are directing funds to go, it's anyone's guess where things will end up. So there could be a lot of innovation. Of course, other banks are under a lot of stress the last couple of days too, but those are the types of things I think customers are going to be looking for. And speaking of, banking in these industries, so there are also questions about banking cryptocurrency entities. We talked about Signature Bank, which was a bank that was open to working with the crypto industry. There are a lot of risks involved with crypto, and so it does require a specialized knowledge. But it seems that their closure is going to leave a void in the financial system for those companies. So Joe, curious what you think. Do you think that those companies are going to be taking their crypto banking business overseas? Or do you think that other players are going to step up in the US to make a play for those accounts?
Well, I think we start with a number of pronouncements that the FDIC and the other agencies came out with towards the end of last year and actually a couple of weeks ago. What they said was, anyone who's now thinking about getting involved in crypto in whatever way you're thinking about doing it, you got to get a permission before you go ahead and do it. And this may have been a shot across the bow saying, we have got real serious concerns about crypto. We are not sure whether or not we want that to be an activity that banks can participate in. And when you take a look at the enormous problems that crypto has had, including 2 weeks ago, the FDIC said, if anyone has got deposits coming from crypto companies, such as Signature Bank, but you better make sure that you've got a good liquidity program in place, and look what happened. So I think there's going to be a definite growing reluctance, if it's not already here, from the regulators saying, we simply want you to get out of this and go find an alternative source of banking, but not on our watch. And I think your point about going abroad is something that may occur, but there's definitely crypto is not the favorite child of the banking regulators right now. FDIC deposit insurance limit. Comments about that?
Yeah, so a few thoughts on this. One is, I imagine a lot of banks right now are thinking about how to offer products that allow customers to expand their access beyond that $250,000 limit. So we're seeing a lot of banks right now marketing sweep account products that would allow their customers to have multiple FDIC insured accounts at various financial institutions. I think there's going to be a lot of creativity in how banks respond to that, because of course, people are going to be very mindful of these insurance limits for quite a while. I don't think that the fact that an exception was made for SVB and SB to honor the full value of uninsured deposits is a precedent that anyone can depend on. So that will be interesting to watch. And then also whether the government responds by considering higher limits to FDIC insurance. So that limit has been changed before. It could change again. That's a policy decision that will have to be made. But that's something that I think will be interesting to watch as well. What do you think, Joe?
Well, we spoke with a number of our clients that had literally tens of millions of dollars in these banks. And I think the question is now, which is going to be a policy discussion, we mentioned a moment ago about what's too big to fail. What is the amount of deposit insurance that should be charged to banks? Is it it's got to be a much higher number than 250,000, unless we have got a completely stable situation where everyone is sanguine that even though you may have $50 million in a bank, it's not going to be subject to, again, another determination by the FSOC that a systemic risk has happened. And I think that the discussion of what is the proper assessment to protect the banking system in light of the corporate needs of large corporations that have got, again, millions of dollars, in a bank, is going to be a debate which we're going to have probably in Congress. Comments about FDIC set-off rights.
Yeah, so this is just starting to gain some traction. Not a lot of discussion about this yet, but The FDIC does have some set-off rights, and as I understand it, has a significant amount of time to decide whether they want to exercise those set-off rights or not. So this is something we're going to obviously continue to monitor. But Joe, have you encountered the FDIC exercising set-off in the past? And how soon do customers typically know if that's going to happen, or is this something that they need to monitor going out 90 days or more?
Well, in the case of a small bank failing, usually it's pretty easy to identify was there a bad guy doing something bad, and you can then quickly say we've got claims against the bad guys, whether it's an officer, director, or board of directors, or whatever. That's relatively easy to do, but the same process is going to happen here, in that the FDIC is now clearly starting an investigation. And as many of our attendees are aware, the Silicon Valley Bank invested in low interest rate, very, very safe federal securities until they went upside down, because they had to, instead of being able to deal with them as held for investment, they had to be changed to held for sale, in which case they had to write down their assets, and we were off to the races in terms of a bank run. So the FDIC is doing it, DOJ is now doing it, and the SEC is now doing it in terms of investigations. And so the confluence of those investigations, and also let me mention, the New York Department and the California Department of Banking, DFBI, they're going to be looking at their investigations as well. Those claims may be brought by a variety of parties, but they're going to be owned by the FDIC in a receivership. And you can, after losing maybe $100 billion, you can be sure the FDIC is going to be then determining whether or not the set-off rights that we just went through a moment ago can be leveled against persons or entities. And so it's going to be something to really be watching very, very closely, particularly if you've got a close association with these two institutions.
Sure. So we're almost at the top of the hour, but we'll get through as much of this as we can. For those who have the deck, we're on the last substantive slide. So another question that keeps coming up is about lending by the receivership or the acquiring bank. So right now we have 2 bridge banks put in place. They have announced that they are going to allow advances, but the future is a little uncertain. There are still a lot of questions that we're navigating regarding servicing agreements, where SVB may be involved in one role in that agreement, but we have multiple other parties involved as well. Participation agreements are also raising a lot of questions. Any other thoughts on that, Joe?
No, let's try to wrap some of these things up. Let me see. What do we have? Litigation for denied claims.
Yep.
Something to be aware of, and this is kind of a general admonition, and that is the FDIC is going to be learning about what they need to do, and so they can deny your claim, they can do something you don't like, and you're going to have to be patient as they work through the system. And that's an important component, a takeaway today. Be very, very patient about what happens, because they may end up turning around and saying, oh, never mind. Oh, we're not going to be doing that. We're not going to be doing it because either we don't have a claim, or because from a policy position, we want the markets to operate, on an effective basis. I mean, for example, anecdotally, we found out from a couple of folks that in terms of payroll today, there was a disruption because some of the FDIC staff people down in the trenches did not realize that they were supposed to pay payroll. And this is going to be, again, a period of time where people are going to have to be patient, and eventually it's going to hopefully move its way through the system. The claims process is going to be part of it. And if you are aware of a potential claim, which you may have to make against the FDIC, except to the extent you get your money back from them, in which case they've resolved your claim, you may have to file a claim. What about litigation for litigation against SVB and SB?
Yeah, so we're highly likely to see litigation against the holding companies. Typically in situations like this, there may also be litigation against directors and officers of the failed banks and of the holding companies. So there's a lot of potential for ongoing disruption caused by that as well. There's also been a call for investigations into what happened here. That could be directly into SVB and SB. It could also be toward directors and officers, and it could even expand beyond that into other market forces that were involved in this, with the social media panic that happened and some of the information or misinformation that led to a bank run that some people are arguing was probably unnecessary. So a lot of options here for litigation. Pick your player. But Joe, let me turn it over to you for any parting thoughts on that or our topic generally.
Oh, sure. Thank you. In terms of the litigation issue, under the Federal Deposit Insurance Act, there's a stay of litigation for 90 days. So the FDIC can go in and stay anything it wants. If you are representing or were representing Silicon Valley Bank or Signature Bank, depending upon where that litigation ends up being placed, you may end up with the FDIC as your client because it may own the litigation. And by the way, there's also other things which we can talk about if anyone's interested. The statute of limitations for the FDIC is 6 years for contract claims and 3 years for tort claims, which is the director and officer liability claims, which can happen. One final thing before we end up is what you see in front of you is if you will, a cheat sheet, which some banks may want to use and their branch offices to indicate how really easy it is to get above the $250,000 individual deposit insurance level. And you can see that if you've got a significant other or spouse, you combine them in a joint account, suddenly you're up to $500,000. If you've got children as beneficiaries, you can easily get above $1 million. And the point here is that if somebody is concerned about this issue, meaning how do I make sure that I've got more than 250,000 in your bank? What do I do? Well, what you can do is you can utilize these alternatives on the consumer retail side to put everybody at peace, easily making changes, very minor changes in terms of the vesting some of these accounts, and you can then you can go forward. We are just about now out of time. And next slide, if you could, we've got this questions, okay? And what this means is we don't have time for questions, but there's certainly going to be a lot of questions. And as Aaron mentioned many times, and as I think I have, things are evolving, things are going to be changing. We're going to have to reacquaint ourselves with a lot of these somewhat arcane rules that are going to apply, which are going to apply now through the bridge banks, and are going to also apply once we finally get an assuming bank. You can probably have an over and under as to when the assuming banks are going to take over. My view is it's going to be probably a couple of months, but we'll see what happens about that. And we're certainly going to be available to help you and your colleagues, whether it's a bank or a non-bank, to be able to work through these problems. We want to thank you very, very much for your attendance today. And hopefully the presentation has been useful to you in terms of being able to understand better what we are all going to have to be dealing with, I think, for a very long period. Thank you very much. Thank you very much, Aaron. And you folks have a nice evening.
Thanks.